All right. So we just went through how the Bank of Canada changes interest rates and then changes the overall economy, basically influence aggregate demand. So the way the bank works is they actually work in reverse. They actually change interest rates first. So if they want to lower or raise interest rates by like 0.5% or lower by 0.5%, they will set their interest rate target and then change the money supply to come out with the outcome of the 50%, a 0.5% increase or decrease, in the general level of interest rates, if that makes sense. So the causal relationship that I explained is the Bank of Canada will increase or change the money supply, which will then change interest rate. But the way it actually works is they change interest rate first, and then they play around with the money supply by buying and selling government securities in the open market that will then in turn give you the interest rate change that they desired. Okay. So this page, in terms of monetary policy, how the bank can set these three variables, I'm not that focused on it. So I'm going to really kind of start here. How does the Bank of Canada manage the economy? So the way the Bank of Canada manages the economy is that they are going to set interest rates. They're going to raise or lower interest rates by X amount. And they're going to do that by, going, well, are we in a recession or inflation? That will determine whether they increase or lower short-term interest rates. So how does the bank actually determine and how they lower short-term interest rates is they do this in two steps. Number one, they change what we call the operating band. So the operating band is this band right here, and the operating band is a band that consists of the bank rate, the overnight loans rate, and the settlement balance rate. So let's just go through what they mean. The bank rate is the interest rate the bank charges big banks on loans. So that means that if the Royal Bank is a little low on cash and they need a loan to meet the day-to-day withdrawals of its customers, they're going to go to the Bank of Canada and they go, hey, I need some money. And the Bank of Canada will be like, okay, I'll lend you some money. However, the interest rate that I'm going to charge you on this short-term loan is going to be the bank rate. The overnight loans rate is the interest rate that one charter bank charges another charter bank for short-term loans. So let's say CIBC is a little short on cash and they go to the Bank of Montreal and they say, hey, I need some cash. And the Bank of Montreal said, okay, fine, but I'm going to charge you this interest rate, and I'm going to charge you the overnight loans rate for this loan. So that is the overnight loans rate. The settlement balance rate is the interest rate that the central bank, which is the Bank of Canada, pays on deposits that charter bank stores with them. So let's say CIBC decides to deposit, $500 million with the Bank of Canada. The Bank of Canada will pay them the settlement balance rate on their deposit. So that is how your operating band is set. Your lower limit on your band is your settlement balance rate. 25 basis point or 0.25% higher is your overnight loans rate. And the bank rate is your upper limit on your operating band. And so the difference between your settlement balance rate and your bank rate is usually 0.5%. So basically, when the Bank of Canada wants to raise interest rate, they will increase the settlement balance rate. They will increase the bank rate, and this whole band will move up, thus increasing short-term interest rates. So that is the first thing they're going to do. That is how they set interest rate, and that's how they move it up and down. So now in the background, what do they need to do is they need to equate money demand and money supply to warrant interest rate moving up or down. So that is going to be, actually, they're not influencing the money demand, they're just influencing money supply. And the way they influence money supply is by something called open market operations. Now, open market operations, there's actually two sides of it. There's something called open market purchase, and then there is something called open market sale. So open market purchase is basically when the Bank of Canada buys government securities like Government of Canada bonds and commercial paper in the open market. So when the Bank of Canada buys bonds in the open market, what happens is people now, instead of having bonds, they have cash, which then they will deposit into their savings account in the commercial banks, and the commercial banks have more money to lend out. So let's just work this out through our whiteboard, and hopefully that's going to make some sense here. So if we look at open market purchase, so let's think about this. Open market purchase, we call it OMP. When the Bank of Canada buys bonds back, let's think about you. When you have a bond, which was a piece of paper, the bank buys it back from you, and let's say you had a $5,000 bond. The central bank buys these bonds back from you. You redeem them through your commercial banks. So now you have $5,000. So what are you going to do with that $5,000? Well, most people will spend it, and even if you spend it, it will end up going back into our banking system as a deposit. So now, when you have $5,000, you can either put it in your savings account, or you spend it and the merchant will put it in their account. So you're going to see an increase in total deposits in the nation. So let's think that everybody redeems their $5,000 bond and puts $5,000 into their savings account. Well, all these accounts, savings accounts at charter banks, just got an injection of $5,000. So now the bank can lend more money. So when total deposits increase, excess reserves will increase. And through the money supply multiplier, you're going to see an increase in money supply, which will then decrease interest rate. And you've already seen that when interest rate decreases, it is going to increase consumer spending, business spending, and net exports, which will then increase aggregate demand, which will then stimulate the economy. So you will often see open market purchase, which will then lead to a reduction in interest rate. And this is something that you will see during a recession. So right now, what the banks are doing is they are buying back a lot of bonds and providing liquidity in our market so that loans don't dry up, and banks are able and willing to lend money to, say, small business owners that may need money to pay their employees. Okay. All right. So now let's look at the other side of the equation. When the economy is dealing with an inflation, the Bank of Canada will want to slow things down, and they'll do that through something called open market sale. So now, instead of buying back bonds, they are selling bonds in the open market. And you will see that happening to, like, pension funds, or, or even yourself, who will say, wow, the Bank of Canada, or sorry, interest rates are high, and I might want to buy some bonds because it's a good investment. So what you're going to see is, let's say you're going to buy a $5,000 bond. Well, what's going to happen is your savings account or total deposits in the nation will fall. Each person buying a $5,000 bond means that each account will fall by $5,000. And you're going to give the Bank of Canada this money, and they're going to give you a piece of paper, which is your bond. But then, in effect, your excess reserve will fall, which means that charter banks, will have less money to lend out, which will then contract your money supply. And when your money supply decreases, your interest rate will increase. And as you have seen before, when there's an increase in interest rate, consumer spending will fall, business spending will fall, net exports will fall, which will then cause your air demand curve to shift to the left. And you will often see this policy move during an inflation. So open market purchase during a recession, and open market sale during inflationary times. So